In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about the fall of the massive German automobile empire. And in the second story of the day, I'll talk about the US debt burden crisis and what it means for us and the entire world. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 20th of March. We recently came across a very interesting headline which said that Audi is set to cut 7,500 jobs in Germany in order to become more efficient. Now, at first glance, I know this might seem like a standard corporate restructuring because a lot of layoffs are happening anyway. But the thing is, if you look a little bit closer, this is actually a deeper issue. Germany's auto industry, which once used to be a massive global force, is now struggling in ways it would not have imagined a few years ago. And to understand why exactly this is such a big deal, let's first understand how much cars matter to Germany's economy in the first place. The country is home to the famous big three in the automobile world, which is Volkswagen, BMW, and also Mercedes. Now, for a very, very long time, Germany's car industry contributed a huge chunk of the nation's wealth. It made up around 5% of the country's gross domestic product and also accounted for more than a tenth of its exports. Countless people worked directly in factories of these well-known car makers, and many more people had jobs tied to the supply chain that supported these manufacturers. In total, about 5.3 million German jobs relied on building and selling cars, which means one in about every 7 jobs across the entire country had some or the other link to the automotive world. Now, for decades, German automakers seemed practically unstoppable. They produced more than 6 million cars at their very peak. Brands like Volkswagen, Audi, BMW, Mercedes, etc. became signs of success in life. They were often those cars that people aspire to drive when they had the money to do it. Exports flowed across continents into America, China, and everywhere else in between. Profits were also very strong because these brands kept expanding and also demand never seemed to falter. But then, starting around 2018, sales began to level off. And when the world began to reopen after that, the entire landscape had shifted dramatically, and Germany's once untouchable dominance was fading very, very quickly. Now, it's very tricky to blame one single factor for the downfall because many things happened at the same time. But one of the most major problems here started to brew in China. See, German automakers have always relied heavily on the Chinese market for their sales. In the late 2010s, around 40% of Volkswagen's global sales happened in China, and BMW and Mercedes also depended on China for a substantial share of their revenue. So all it took was a downturn in that one market for these very companies to feel some serious pain. Sure enough, after the pandemic, that's exactly what happened. Chinese car buyers started shifting to local brands, especially as electric vehicles took off in a very big way. Companies like BYD started to offer competitive EVs that were often more affordable and also came with better technology or longer driving ranges. And meanwhile, German car makers found themselves playing catch-up in the electric car race, and they also had not invested in the crucial battery supply chain earlier on. Now, most batteries for German EVs had to be imported from China or South Korea, which basically left the German manufacturers exposed to all kinds of supply chain and cost risks. Then another blow arrived in the form of Chinese EV exports into Europe. See, China was building so many cars that it needed new buyers outside its own borders. Europe, including Germany, became a very important market. In the first half of 2023, Chinese EV imports into Germany jumped by a massive 75%. And these vehicles were often cheaper, and once Germany ended its EV subsidies in late 2023, the advantage for domestic brands shrank even further. At the very same time, Germany's government had to weigh its historically close economic ties with China against the need to protect local industries. Plans to impose tariffs on Chinese EVs moved forward within the European Union, but Germany itself was hesitant to escalate tensions. German car makers worried that if they openly supported protectionist measures, they might actually face retaliation in China, which remained a huge market for them. And on top of that, Germany faced an energy crisis triggered by the war in Ukraine, and before the conflict, Germany got over half of its natural gas from Russia, which basically kept energy costs relatively low for them. But sanctions and disruptions to Russian gas supplies forced Germany to scramble for alternatives, driving up energy prices as a result of it. Now, for your context, car manufacturing is an extremely energy intensive process, and German companies had to pay more to run their factories than some of their American or Chinese counterparts. And that, of course, pushed profit margins down even further at a time when the industry could absolutely afford it the least. And meanwhile, there was the issue of overcapacity as well. See, during their boom years, German automakers built extensive factories to meet ever rising demands. But when the demand shrank, they actually ended up with more capacity than they could profitably use. Also, cutting back on factory operations in Germany is not very simple either, because workers there enjoy strong rights and unions have a very big say in how companies are run. Now, this is good news for job security for sure, but it makes quick restructuring very, very difficult. Any major layoff plans basically has to go through negotiations, so even if a factory becomes unprofitable, closing or even downsizing it cannot really happen overnight. This system basically protects workers from sudden job losses, but it also slows a company's ability to adapt in a crisis. And because of all of these factors, companies like Audi and Volkswagen are trying drastic measures now to survive. Audi, for example, struck a deal with its unions to eliminate thousands of jobs, mainly from administrative and development roles rather than assembly lines, while Volkswagen has plans to reduce its workforce by tens of thousands by 2030. There is also an urgent push for government support in the form of new subsidies or relaxed regulations as well. The authorities, of course, are also stuck in a very difficult spot here because they want to help their world-renowned car brands, but they are also bound by European climate goals and are worried about keeping trade relations with China on stable ground. And as a result of all of this, everyone is now wondering whether these particular efforts will be enough. German car makers, like I said, once absolutely ruled global markets, but the industry is now at a point where it fears being outpaced, particularly in the rapidly growing electric car segment. People are basically worried that the German automobile industry might go the same way that Nokia did, which was basically a leader in mobile phones once before it failed to adapt and got overtaken by more agile competitors. Now, of course, it is still very early to say how all of this will exactly play out, but the job cuts at Audi and the talk of restructuring at other major automakers definitely show that concerns are very, very real. With that, let's move on to the next story of the day and talk about America's debt burden and what all of it means for us and the world. Now see, if you've been around finance news lately, I'm sure you would have come across discussions around America's debt. For your quick context, America over the last many years has borrowed vast sums of monies from investors around the world. Now, the US can do it a little more easily than most other countries because the US dollar is considered the world's reserve currency of sorts. Basically, people trust that if they lend money to the US government, they will be repaid. But still, lately, this once comfortable arrangement seems to be less stable now. Interest payments on the debt are becoming a huge part of America's expenses, and its annual deficits, where the government spends more than it earns, keep growing right now. Between the Cuban Missile Crisis in the early 1960s and the fall of the Berlin Wall in 1989, America spent only about 1.8% of its gross domestic product on interest. Today, it's past 3% and that figure is still rising. And that sort of a jump makes some analysts wonder if the entire system is at a risk of buckling under its own weight. And the worry comes down to a simple reality. Paying interest on debt does not really directly create new roads, educate children, or even fund healthcare. It is just the cost of keeping lenders happy. And if that cost grows large enough, other parts of the government's budget might actually start to suffer cuts. Now, critics here also point out that at some point, the burden of these interest payments could be unsustainable even for a country as wealthy as the United States. There are examples of smaller economies like Pakistan and Sri Lanka where too much debt actually led to severe financial crisis. Now, of course, the US has a much bigger and more diversified economy than these countries that I'm talking about. But the question still remains, is there a level of debt that can strain even the most powerful nations? A historian named Niall Ferguson has offered a very interesting way to think about this. He calls it the Ferguson Law, though the name does not really refer to himself, but actually to an 18th century philosopher named Adam Ferguson. Now, the idea is that once a great power, like the United States in this case, spends more on servicing its debt than on defending itself, it moves into a very dangerous territory. In other and more simple words for you, if the interest payment on its debt outstrip what it spent on its military for an extended period, it may actually begin to lose its global standing. Now, of course, 1 or 2 years of high debt costs may not really be disastrous, but the problem starts when it becomes a long-term trend and the power in question could actually start to weaken at that point in time. The military dimension matters here because historically speaking, a country's strength and influence often hinge on its armed forces. If high debt payments reduce military spending, rivals might actually start to sense an opportunity to challenge that country's interests around the world. Now, for your quick context, Ferguson is a controversial thinker and he has made arguments in the past that many people disagree with, like claiming the British Empire was on the whole good for India. Now, you don't have to accept everything he says to find some value in this particular hypothesis about debt. In fact, he also looked at several historical empires, each of which was once a dominant force but eventually lost its leading position. And in every single of these cases, there was once a period when these powers were channeling too much of their income to pay off their debt, leaving less money for their own military. And that is where he sees a pattern, though he also admits that it is not really a bulletproof prediction of the future. Now, Spain back in the 16th century illustrates exactly this point very beautifully. Now, thanks to the enormous flows of silver from its colonies in the Americas, Spain seemed undefeatable for a time. Its tertios or elite infantry and its powerful navy fleets allowed it to project strength across much of the world. Yet, this wealth from abroad encouraged reckless spending and huge debts started to pile up as Spain sought to finance multiple wars. And by the late 16th century, interest costs were running dangerously high for them. The Spanish crown defaulted on its debt more than once, which hurt its credibility and also drained its ability to keep its military strong. Eventually, they lost conflicts like the 80 Years' War to the Dutch, who had actually managed their finances a little more carefully. Spain then gradually slipped from its position as a leading superpower. Louis XIV's France is one more case where a wealthy, formidable power saw its fortunes turn around. France, for your context, was one of the most powerful states in Europe at one point in time, and they were backed by a massive army and a very strong economy. But after engaging in very expensive wars, the monarchy started struggling with deficits. When France decided to support the American colonies against Britain, its debt ballooned even further. And by the late 18th century, more than half of France's entire budget was actually going towards interest payments. And that, of course, left very little for maintaining its army or even running the country's administration in the first place. Discontent grew, and the resulting crisis played a huge role in sparking the French Revolution. Meanwhile, Britain, which is France's main rival, had built strong financial institutions. They could manage debt a little more smoothly, which basically helped them triumph in this era of intense rivalry. The story also repeats itself in the Ottoman Empire. See, at its peak, the Ottomans ruled over huge territories in the Middle East, North Africa, and parts of Europe. Over time, though, their administrative and revenue systems failed to keep up with the costs of a modern state. Wars became increasingly expensive, and each one was paid for with borrowed money. Eventually, of course, interest costs took over about half of the Ottoman budget. And because they were unable to meet their obligations, the empire defaulted and allowed European creditors to seize control of its revenue collection. Its military then suffered chronic underinvestment at a time when the other powers were upgrading their militaries. And repeated military defeats in the Balkan Wars and beyond signaled the empire's irreversible decline of sorts. Another example is Austria-Hungary in the early 20th century, where they faced a very similar dilemma. It was a large empire at the heart of Europe, but it had a very confusing revenue system that led to constant deficits. Debt servicing ate away its ability to fund the military properly. And by the time World War I broke out, Austria-Hungary was unprepared to face the modern militaries of powers like Germany or Russia. And this war effectively dismantled the entire empire, showing that a weakened financial base can have catastrophic consequences when major conflicts arise. Britain looks like a partial exception here though. Throughout much of its history, Britain had robust institutions. The Bank of England regulated the money supply, and a reliable system of taxation supported a sturdy bond market. And even though Britain borrowed very heavily, especially during the wartime, it usually managed to repay its debts without gutting its Royal Navy or weakening its broader military too much. Now, this of course allowed Britain to remain a leading power for a very long stretch. But still, even Britain could not really dodge this trap entirely. Between the two world wars, the cost of servicing its debt often surpassed what it spent on defense. It continued to operate as a great power for some time, but its financial policies became increasingly desperate. Eventually, it could not match the new superpowers, which is the United States and the Soviet Union, and lost the global dominance it had once enjoyed. Now, Ferguson's conclusion here was that whenever great powers let debt costs get too high compared to their military spending, their global influence starts to slip. Recently, data suggests that in 2024, the United States spent 3.1% of its GDP on interest payments alone. And this is compared to only 3% spends on its own military. And this breach of the so-called Ferguson's Law raises questions about whether or not America might find itself making tough choices in the years to come. Because in one way or the other, large deficits and high debt can really limit what a country can do. If economic growth slows down or if a crisis hits, that debt does not really magically disappear. And when faced with hard times, governments might cut back sharply on defense or other vital areas, which leaves them a lot more vulnerable than they might realize. By the way, it's very important to note here is that none of this is a guaranteed prophecy of the doom. The United States is still a massive economy with many strengths, and it has navigated high debt levels before, like right after the World War II, without losing its place as a global leader. But the lessons of history suggest that high debt can narrow a country's range of safe options, and as writer Morgan Housel puts it, when a crisis arrives, a government saddled with debt finds it much harder to adjust because it still has to keep making those large interest payments. Now, that situation can become a serious constraint, forcing decisions that may weaken a nation's long-term capabilities and role in the world. Now, like I said, none of this means that the US automatically is destined to follow the same fate as Spain, France, Ottomans, Australia, Hungary, or even Britain. And that is because every period in history has its own peculiarities. But it's a cautionary tale for sure. The lesson is that debt can look harmless for a long time, right up until it actually does not. Now, borrowing definitely helps a country avoid raising taxes during emergencies, and it can also fuel important spending without feeling the immediate pain. But the problem is that the pain can actually appear later, often at the worst possible moment. For now, many people argue that the United States can handle its debts because of its economic scale and the dollar's global status. But still, Ferguson's historical examples show what exactly might happen if conditions change and if interest bills keep climbing. Historically speaking, no empire ever believed that it could topple at its height, but still several of them did. So in the end, the question is not whether the United States is too big to fail or not, but whether it can continue to manage its debt so that it never has to find it out. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, legal petitions against Adani Green Energy's 484 megawatt wind farm project in Sri Lanka have been withdrawn following the company's decision to exit the 442 million US dollar investment. The project, which was approved in 2022, faced opposition due to environmental concerns and the lack of a competitive bidding process. Second, India, which is the world's second largest steel producer, is considering a 12% safeguard duty on most steel imports for 200 days to counter rising inflows, particularly from China, which saw an 80% surge in steel exports to India, reaching 1.6 million tons in the first 7 months of 2024. This move follows requests from Indian steelmakers, including Jindal Steel and Power Limited and JSW Steel Limited, seeking protection against cheaper imports. Third, Alphabet Incorporated has announced its biggest acquisition to date, acquiring cloud cybersecurity firm Wiz Incorporated for 32 billion US dollars in cash. This comes in less than a year after Wiz rejected Google's $23 billion bid, citing potential for a higher valuation through an IPO. For your context, Wiz was founded in 2020 and had reached a $12 billion valuation in a funding round in May 2024 with investors including Sequoia Capital and Green Oaks. That's all the news and stories I have for you today. I hope you found this episode interesting. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.